Welcome back to Market on Close. I'm Oliver Rennick. We're going to take a look at some of the macro story of the day by bringing in Alan Nuckman, the Chief Market Strategist at Agora Financial. Alan, great to have you back. Let's talk dollar.
Good afternoon, Oliver.
A little bit more strength here once again the past week. So what's behind it this time? Are you able to sort of untangle the confusing web of factors for the greenback?
Well, there's a couple of things I want to talk about, but let's talk about it's a little bump so far. Now, even though we've seen interest rates at multi-year highs, you're seeing the dollar still a long ways away, more than 100 ticks away from the August blow-off top that we've seen. So that's an interesting separation and divergence there that's held Thursday, Friday, now again today. Now, what happened in the 10-year note today made some new relative lows, and it looks like we could see a higher close today. So that's how bottoms get put in. Now, that's a bullish factor, number one, that rates maybe have stopped moving up here, but also the intraday action that we saw in the S&P, the reversal where we took out the September lows, and it looks like we could see a higher close there. That's also very bullish. So I'm liking the way things are setting up, but obviously we want to see what the dollar does for the next few sessions or so.
I love the first point that you made there, Alan. Well, I like them all, but let's come back to the first one for a sec, because Ben and I talked about that this morning, which is you could be tempted to look at the basically month of green here in the dollar over the past 4 weeks, put it next to Treasury yields and say, all right, this correlation has come back, but Treasuries have really broken out past their range, whereas the dollar, as you point out, we have not tested the same level. I mean, basically since June, this thing, for the most part, has kind of plateaued to the side.
Right. So you're seeing that divergence there. That's important. And to get back to interest rates, yes, rates are rising, and I've talked about this many times before. I look at this as a healthy sign. It's an A on the report card for the economy. We're able to raise rates. Now, the raising rates, if you look at the Eurodollar futures and see what they're pricing in, we're pricing in a hike in December, a hike in March, and a hike in June, and kind of a hike, maybe a half a hike next September. After that, nothing. Zero. Nothing until 2023, 2000, so for 4 or 5 years out, there are no rate hikes priced into the market at this point. So maybe that's why the dollar's not playing ball with the interest rates right now. It's looking to the future, and there's not that many rate hikes in the pipeline. Now, let's remember, the 10-year note is not, not governed by the Fed, is by supply and demand. So obviously it was very, very oversold, but 4% is the key number in the 10-year note. That's the halfway mark of the 2000 high at 6.5%, and the extreme low at 2016 at 1.5%. So until we get to 4%, we're not even to the midpoint of the action in the last 15 years.
Yeah. Alan, if we talk about some of the other trade-offs between the dollar and other currencies, it's been at the expense of the euro as of late, but last week when we were looking at the rate of economic surprises, U.S. is back, and we've had some really big surprises to the upside in terms of our own data, but the Eurozone has basically been steadily improving really since the spring. The latest sort of headline story about Italy and the budget and the ongoing Brexit drama is maybe holding that back. If there is some calm in terms of the political scene, will that help to push that dollar lower?
I think so. I think you could see a snapback. The latest crisis du jour happens to be Italy and, whatever the leftover remnants of Brexit. But if you look at that Eurozone like you talked about, it hasn't really participated in the stock rally to the same extent. So typically they move somewhat in tandem, but they've diverged a bit. So I think that may offer some value that U.S. stocks obviously have led the way recently, that some of the foreign stocks could start to play ball and start to move up. And I think that would also benefit, obviously, their currencies, would benefit from this snapback. And again, I'm not fully convinced, I've said this many times, and I guess we're all the way into October of 2018, that this dollar strength that we've seen so far this year is for real. Let's remember the decline that we saw in 2017. I still want to chalk this up as an oversold bounce in the dollar. Yes, it seems to have a little bit more strength than I had anticipated, but in the big picture, I still believe the policy is for the dollar to be down, and that is very, very helpful to the energy markets, metals markets, and stock market in the long term. Obviously, gold's not doing so well today.
Let's talk gold here. Good transition, Alan. This is just, a hopeless market at this point. I mean,
sick.
How does it get out of the malaise?
It's sick. And if you look at it, gold's been trading between, or had been trading between 12.15 and 11.85 for more than a month. It looked like it was ready to base out. It looked like, that maybe it could push through that 1,200. It was up $10 last week on a weekly basis. It looked like it was maybe showing some signs of life, but I don't know what's going to do it. But at some point, the metals markets are going to have some sort of squeeze and comeback. I don't know what the catalyst is going to be. I have no idea. But as in my 25 years plus of experience here, I'm not going to tell you how old I am. I've realized that when I cannot think of one good reason a market's going to move up, that's usually when it happens.
Now, one other item here to come full circle here, because we started talking about interest rates and inflation, right, which is, potentially maybe showing up to some degree in the longer-term bond market now finally. But the fact that we have investors selling off the longer end of the bond curve finally to an extent that might suggest they see inflation coming, but yet that doesn't put any bid into gold. Has gold essentially, is it no longer an inflation hedge? Has that been like debunked this year or what?
I have no idea what is happening to gold. There have been so many reasons that it should have firmed or it should have bounced, and it just absolutely positively hasn't. So the old school trade is, you often learn as much or glean as much as from what something doesn't do versus what it does do. So at this point, all I can say is it offers some value. The lows are what, 1167. So what are we, $20 off the lows? So if you can look at with some longer term options or options plays, maybe look at some metals and mining stocks, look at GDX as the miners ETF. That'll tend to move faster when gold does go.
Yep.
But remember, it wasn't so long ago that we were talking about when crude oil was at $45 a barrel. We were talking about the same kind of mentality. No matter what happened, the market would not get its feet under it. And so at some point it will, but I'd be looking 6 months out, 9 months out, a year out, and positioned that way for when it does turn, and a falling dollar might be that catalyst.
All right, Alan, great stuff. Fantastic conversation. A lot of analysis here to process. Appreciate it, Mr. Nachman. Thank you.
Thanks, Oliver.
All right, Alan's the Chief Market Strategist at Agora Financial. Like that. All right, up next.